Ladies and gentlemen, welcome back to Conversations with 812. I have a very, very special guest with us today. Someone that's a close friend, someone that's I've leaned on in our business as well. But he's here to talk to us about all things private equity, about finance, and maybe we'll throw in some Porsches and 911s too. But without further ado, Kelly, welcome to Conversations with 812.
Thank you very much, Bilal. It's a pleasure to be here.
Thank you. Thank you for being here. Kelly, just for our audience first, I'd love for you to give us a bit of an intro about yourself and your field and what you do, and then we'll build up from there.
Certainly. I appreciate that. In a nutshell, it's about 10 years of being a corporate stiff, growing up in commercial banking. Made an interesting pivot into consumer finance, which was a lot of fun, bit of the Wild West in comparison to the stuffy commercial underwriting side. Fell backwards into international private banking for a couple of years, and then migrated into private equity, where it's been the last decade helping wealthy investors find private companies to buy and own and operate. The last 3 of those years was with an established family here in Toronto on the buy side. And then most recently got the entrepreneurial bug, which means typically that I'm unemployable, and started my own consultancy in the family office space with 5 good friends. And then most recently, we're putting pen to paper on a private equity fund focused on professional women's sports across U.S., Europe, Canada. So we're pretty excited about that. And then as a hobby, helping to build some businesses down in Mexico.
Love it.
A great excuse to get out of Canada during the winter months, but it's been a fantastic experience.
That's awesome. Thank you so much for that. Kelly, I want to ask you first, what is private equity?
Well, it's interesting. I was just at a founders dinner last night, which tends to skew more venture capital, if you will. And from my perspective, having played a little bit in both areas, venture capital is investing in revenue growth without as much concern for consistent cash flow and profitability, whereas private equity tends to be more focused on investing in stabilized cash flow. And so it's, in theory, it's de-risked, which typically means a lot of the return profile outside of being an excellent operator is financial engineering. So you tend to get a little more creative with your service providers. It's a little less exciting, but a little more stabilized. And so it tends to attract a long-term mindset, a more risk-off investor. And it's becoming more and more of a portion of a larger, sophisticated investor's portfolio to tie into the private markets, especially as valuations on the public side are bouncing around a little bit. And it's interesting, the more recent challenges that some of the public market side have had around liquidity have also been reflected on the private side and liquidity. But yeah, it's in a nutshell, private equity in my mind is more stabilized, commercialized companies that have a proven market fit, that have generated consistent cash flow for at least the last 5 years or so. And so it does represent a bit more of a conservative investment than your venture capital side.
Got it. I want to pick up a few things in what you just said there. There's a lot of, if you Google private equity and you hit on that tab that says news, and one of the first things that you see a lot of times is the private equity bubble, right? How do you view that? And not only am I talking about just on Google, but even if you actually go into some business news networks, you go look at some alternative podcasts. I can name a bunch of them, and a lot of them cite that we're in a private equity bubble, and it's a constant thing that we hear. How do you respond to that? And is there some truth to that?
The private equity space it runs the gamut. But anytime you've got less sophisticated individuals jumping into a market where you're buying private operating businesses, and if you're not an operator, the only thing you can rely on is financial leverage or amalgamation. And when markets turn, interest rates increase, cost of debt increases, bank support tightens, and you lose the financial leverage side, you lose the ability to then continue to consolidate. It does expose the individuals that are not very good operators.
Right.
And so from an underwriting perspective, when I look at private equity opportunities to invest, whether it's through a fund or direct, is do the individuals that are making the investment have the ability to add value from an operational perspective? And what that allows you to do is insulate yourself from the vagaries of the valuations in the market and allows you to endure the downtimes because the company itself can be protective of cash flow and margins if it's operating well. But from a valuation perspective, it's a point in time. From an overvalue or undervalue perspective, the beauty of the private side is it's whatever anyone's willing to pay for it.
Right.
So it's not as, a lot of the valuations are internal until there's an external transaction that takes place. So similar to your home, someone can tell you it's worth 30% less, but that's not meaningful unless you're interested in selling. And from my perspective, the beauty of private markets versus public is on the private market side, insider trading is encouraged. And that's where the bulk of the value comes from, is you have some sort of mismatch around what you understand about an industry that allows you to exploit that to the benefit of investors or yourself as the investor. Whereas on the public market side, obviously you get a bit of a slap on the wrist.
Of course.
If you're insider trading. So me being a relationship guy and having built my career around relationships, it's being able to leverage the inside knowledge of those relationships to take advantage of building good businesses and generating value for investors or yourself directly as the investor on the private side.
And that's a great point that you mentioned there. And anyone that's watching that's new in business, just in general, I don't think this is industry specific, but I think what you just said there about relationships is key. In any business, you have to have a very strong network of people that you can lean on, you can speak with, and like you said, get that insider knowledge. Which I guess it works both ways, not only from a point of view of what's coming in the market and being able to get ahead of the trends. I guess you can. Would you agree with that statement that you can sort of get ahead of what's coming down in the industry if you have that insider network with different businesses, different relationships?
It's an interesting way to put it. I'm not sure necessarily. Obviously, if you know the folks that are on the cutting edge, getting ahead of certain trends, but I'm not sure because it's more consistent, stabilized cash flow. It's less about what the latest and greatest is necessarily.
Right.
Now, to your earlier point about valuations, where you have large fund groups that are pure aggregation plays as opposed to operational enhancement plays, they do tend to play the hot ticket or the hot industry, if you will. And it tends to be one group that sets a standard around, like there was a very good friend who works for a large U.S. private equity fund that minted a tremendous transaction in HVAC, heating, ventilation, and air conditioning. And there's an industry where there's not a ton of innovation that takes place around furnaces and air conditioners. It's not sexy. But they found a buyer that was willing to pay a significant premium. And then all of a sudden, every other private equity fund is like, oh, well, if we can get those kind of multiples, let's go. And so, again, coming back to the private side, having your company worth what someone else is willing to pay for it, if you find that one willing buyer at whatever valuation you're happy with, and you make that transaction, that can move an industry as far as shift groups that are receiving consistent amounts of capital that have to put it to work into certain industries and drive up valuations. So HVAC was a hot ticket for a little while, despite not having any significant innovation driving it. So it wasn't necessarily a trend. It was just somebody somewhere was willing to pay a lot for someone else to do the work to amalgamate a bunch of companies. And so there's the follow-on. And so domino effect or fast follower effect.
Right. So a transaction like that, because it carries a lot more weight on the operational side of things, I think that, in the way I look at it from my lens, I think that is the right way to do private equity. Would you say, rather than compared to if you're just doing financial engineering?
Yeah, and financial engineering from the perspective of just pulling a lot of leverage from a financing partner, putting a lot of cash flow strain on the business, in turn stripping out a bunch of the expense items in the company, which is kind of the reason why private equity got a bad rap for a little while as far as the communities that these companies are operating in, because it was a relatively short time frame, typically 6-7 year hold period. Come in, over-lever a business, strip out a bunch of the operating costs, and then try to flip it to the bigger fool model. Someone else is willing to pay a multiple for it, as opposed to your point, having that longer-term approach where you can actually add significant operating leverage to it, grow margins, grow revenue, and operate it as though you own it, with a longer-term outlook. And there's been a number of funds that have popped up in the last 5-10 years that are looking at that longer time frame as a way to be more founder friendly in acquiring businesses that are family owned, that have a lot of the kind of relationship value built into it, and typically family name on the wall. They're not looking at someone, they're not typically looking for someone who's going to come in on the financial engineering side, strip out everything, fire a bunch of the people that they're going to see at the local supermarket, and then flip it out to someone even bigger. They're looking at someone who's going to take this as an anchor footprint and continue to grow it. So they're looking for that strong operating partner that likes this business as an anchor footprint to then continue to expand and grow.
Right. That makes sense. I'm going to go back to the relationship side of things. How important is that in your line of business, in the private equity space, in the family office space, to anyone that's new in that line of work, that is, or maybe just interested in getting into that line of work? Where would you place that relationship aspect of your business? And the follow-up question to that would be, where do you start?
Interesting question. I mean, I kind of fell into private equity myself unintentionally, through a friend of mine who I worked with in commercial banking at one of the big banks, who decided to take the plunge and jump into private equity himself.
Was it the green bank with a sofa, or was it the blue bank with a lion?
In this case, it was the blue bank with the lion. So we had spent a few years in back-to-back cubicles, built a relationship. He went out on his own and got into alternative energy early on, and built a nice business, and was looking for someone on the dedicated business development side. And so I joined him, and for 3 years we ran around speed dating private company opportunities to expand beyond alternative energy and in different avenues of alternative energy. Had a lot of fun. So for me, it wasn't a dedicated focus that I wanted to be in private equity, but I knew I wanted to work with good people, strong track record, that had good relationship with. And so as far as relationships being an advantage in the space, relationship and reputation, if you've got a consistent track record of execution, you're typically going to see certain deals before they're more broadly marketed, which in theory can lead to being able to pay a lesser price because there's not as much competition to acquire it. And in a lot of transactions, the ability to consistently close in a transparent way is meaningful. There's a lot of groups that have a track record of submitting an expression of interest, and then once they get exclusive on the underwriting side, then start to retrade and retrade and retrade. Oh, we found this wasn't disclosed, so now we're going to pay less. And if you've got a consistent track record of delivering on what you say you're going to deliver on, ability to consistently close deals, you will start to see, through that relationship being built and that reputation being built, advanced looks at certain opportunities. And it's easier if you've got an industry specialization where people on the sell side know that they don't have to retrain you on what this industry is and why this business is valuable, and you can see it more consistently. And so that on the private side, again, if you get early looks at things, if you get to jump into situations that are non-auction, where you can deal with a business owner directly and explain the value of your money beyond just money, then in theory, you should be able to see some more attractive deals from a valuation perspective or from a quality perspective. But the beauty of private equity is there's groups. There's a relatively new family office-backed PE fund that's looking for distressed opportunities. So they're not looking for quality. They're looking for the distinct lack of quality, where they're the folks running into buildings that are on fire when everyone else is running out. And their thesis is they can extract value from that situation when they've got the operational expertise to then go in and grab those assets and that business model at fire sale and then resurrect it.
And I think that's a very, very important point. And there's in that last note that you mentioned there's a lot to unpack there, but I want to go at it one at a time. That last piece that you talked about, building on fire and these distressed PE funds or funds that are looking for these distressed sales, they're running into that and hopefully at some point salvaging that company. But I think that's a very clear distinction that needs to be made in the private equity space, because that's where I think that a lot of the private equity professionals get that bad rep of that sleek vulture, if I can use that term. But at the end of the day, those are the guys, those are the funds, guys or girls, that are going in and saving that building that's on fire and hopefully, resurrecting it to add some value. And if that requires, ripping out some additional, cream from the top or the certain expenses in that business, again, on the operational side, I think that's where you add value. And I think that's a very important distinction that needs to be made. So you don't have that continuous, sort of bad rep to private equity. So I agree with that. But then another thing that you mentioned when you were speaking there is that it's not just about the money, but it's the value of the money. Touch on that a little bit more.
Well, it's interesting because there's the headline price that people are willing to pay for a company, but then it's from a specifically, and I've spent a lot of time on the founder-owned business transition side. There is a concern from the vendor around, is this individual coming in who's willing to pay X for my business a safe steward of my business going forward? Because they've built, their legacy is what they've built, and they don't want to necessarily see it dismantled in a relatively short period of time, especially if they're outside the big city and they're one of the principal employers within their town. There's a lot of pride and reputation built up in it. And so a lot of the differentiation and negotiation around price, where you may not have to be the highest price, but you have the greatest alignment of values with the vendor around what you see this business as and what you intend to do with it longer term. So money is the great commodity. Everybody's money is worth the same. There are situations where someone's just looking to take the highest price and walk away, but traditionally we haven't found a lot of that, because there is a lot of blood, sweat, and tears that goes into building a good business. And so to hand it off to someone who is going to strip it for parts and sell it again 5 years later to the highest bidder, it is an emotional attachment that needs to be overcome. And so a good sell-side advisor plays a key role in the mental aspect of getting the entrepreneur ready to sell. And then from a alignment of value perspective, that's where a lot of the funds can come in. If they can tell a good story around the value that they bring to the acquisition and what they intend to do with the business, it goes a long way towards allaying a lot of the fears of the vendor in knowing that things will progress as they would like to see, but for whatever reason, age and stage, they're not willing to take it to that level themselves.
So in a nutshell, and kids, this is a golden nugget right here. So, for example, let's say if I'm a grassroots business owner, let's just go back to the HVAC example. And I've built up my business from the ground up. I've put the blood, sweat, and tears into this business, and I got it to where it is now. And when I'm looking to sell, if I get two offers, one is a, ABC Holding Corp that's looking to buy my business. And on the other side, and they're offering me more. But then, if I sell it for 5-10% less to this other buyer, but the reputation's there and they're going to continue my legacy forward, I would, as a seller on the sell side, I would be much more inclined to sell my business to that, to the latter part, right? Am I understanding you correctly there?
Yeah, that's the message that I'm conveying, is that there is value beyond just money.
Correct. I couldn't agree more. Talk to me a little bit about, and tell everyone, we always hear in the media that, a certain politician, high-ranking politician, is now working for Goldman Sachs as a board advisor, or even in the Canadian space, and this is not just limited to the U.S. We see this in Canada too. A lot of retired politicians will end up going and sitting on a board of a big bank or of a PE firm, whatever the case may be, capital firm. How do you see that?
As far as influencing the company's ability to operate, depending on size and scope, it may play a role. I've spent most of my career in kind of the lower mid-market across Canada, and it's more municipal politics that has an impact. And I find that it's the business owner themselves, through either industry lobby groups or direct relationships themselves with the local mayor, with the provincial politician, provincial representative, that makes an impact. But I think the days of bags of money in closed rooms, changing regulations overnight, are well behind us. But getting an understanding of, if you're in residential real estate development, and the town development plan is to develop on the west side of the street before the east side of the street, then you obviously want to be landowner on the west side of the street. And so having great relationships, again, coming back to relationships, having great relationships at all key stakeholder levels that impact your business makes sense. And having a business owner that recognizes that is very advantageous to the growth of the business. If they're the mad scientist locked in the basement, cranking out a wonderful product, there's so many stories. It's more on the venture capital side, but so many stories of an amazing tech that's been created, or an amazing business model that's been created by a reclusive genius, where it never gets commercialized to its fullest extent because of the lack of ability to tell the story, build the relationships, and make the connections necessary to facilitate the growth. But I don't see the political side of it as being that disadvantageous. The biggest bugaboo from families that I've known across the country has been more from an Alberta perspective, the liberal approach to being more ESG and anti-oil and gas, whereas it's a very resource-rich province that has been held back. But even that said, with Carney in the chair now talking about nation-building projects, that is very pro-Alberta. Mm-hmm. So you still have the Liberal Party in power, but they're recognizing that the ability to leverage natural resources is a distinct advantage from a Canadian perspective, from a macro global perspective. And so it's seen generally as a positive thing. And then if we can get more value enhancement capture within the country, where we're not just pumping out raw natural resources, we're actually refining, enhancing the value before we sell, we can capture a lot more of the employment and a lot more of the value to create a brighter future for Canada in general.
Yeah, I agree. You said Mark Carney. I didn't. So I'm going to ask you, is he the right person in Ottawa?
So it's interesting. There's the voters' perspective, which obviously represents that he's the right guy. And even from a Pierre Poilievre perspective, he's run in consecutive ridings and not been reelected in. So again, the voters seem to be saying Mark Carney's the right guy. He's certainly a more polished and professional global outlook with great domestic business experience in the chair. I don't know that he would be as pro nation building project if it wasn't for our friends to the south saying you have to be more self-sufficient, but it's regardless, it's a beautiful thing in my mind.
I agree.
To become a more self-sufficient country and look more broad in our trade relationships. So I think long term it's going to be great. Only being 5 months in, the jury's still out with regards to how effective we will be as a country at breaking down interprovincial trade barriers, building these kind of nation-building, natural resource driven major projects. But from my perspective, it's all good. And I can see from a private equity perspective, taking a look at those macro trends, and again, earlier to your point with regards to finding the next greatest thing, all of these nation-building projects take a very long time and consume a large amount of money. And so once it starts, it continues. And so you have the ability to place a longer-term thesis around capital deployment to leverage what's being built, to build all the picks and shovels around it, to build all the ancillary businesses, to then invest in the value-added refinement of natural resources in country before it's sold and capture more of that value. And so I think long-term, it's a good thing. And whether it's a conservative in power or liberal in power, I think if we recognize that our global positioning as a natural resource-rich country is our distinct competitive advantage long-term, then I think that's great for the country and positions us well to compete globally on a macro level, which then allows more capital to stay in Canada to build up more of the economy in Canada, more employment in Canada, more companies in Canada, more value add in Canada, stop as much of the brain drain down to the U.S., ideally enhance compensation to retain talent in Canada if you're getting more value capture here. So I think the trend, as much as the political rhetoric has been a negative connotation over the last handful of years, I think the trend is very positive for us to become more self-sufficient.
Mm-hmm. Do you think that this whole approach, our relationship with the U.S. right now, we could sit here and talk for hours about that alone. But the point that, that I really want to focus on is, do you think that this, looking inwards and building new trade relationships and all that sort of fun stuff, do you think this is a temporary thing till we have DJT in the White House, or do you think this is sort of a more of a long play and this is how it should be? As in, if Donald Trump gets out of office in a few years, we have whoever comes into office next is, let's just say, not as aggressive on this whole tariff trade thing, and we become friends again. How do you see that? Do you think this is temporary, or we need to invest in this long term?
Well, from my perspective, the continued investment in Canada and in these nation-building projects and interprovincial trade is definitely a positive long-term. So I'm hopeful that it will continue. And it's always, there's the debate around short-term change of habits resulting in long-term change. When you look at pre-COVID, 5 days in the office was pretty standard. Then, because there was the ability to fall back on, well, if people work from home, nothing will ever get done.
Yeah.
And then you're forced into a situation to prove that thesis during COVID, where everyone's working from home and magically stuff's still getting done. That said, fast forward a couple of years, we're in a very robust hybrid working relationship with most employers, where now employees have the flexibility to work a couple of days in the office and a couple of days at home and enhance, call it work-life balance, call it mental health aspect, stay out of the crazy grind of commuting a little more frequently. And the companies were forced to invest in the technology to allow not only remote work, but being able to monitor and control remote work as well. So when you look at the temporary nature of the stick being used being tariffs, it's changing short-term behavior, but there will be some enduring effects of that. So if you're a manufacturer that typically exported 90% to the U.S. and you're being hammered by tariffs, and you establish a relationship with a buyer over in Europe, a buyer over in Asia, a buyer in LATAM, and things start going well, it's not necessarily that likely that you're going to step back away from that once the tariffs go away. You'll likely still continue to supply the U.S., but then you have now some leverage over pricing power over options are always power. And so if you can trade off between LATAM, Europe, Asia, and the US, you can ultimately, ideally, build a broader demand for your product and enhance some pricing power. And the world's a big, beautiful place.
It is.
So getting out of the car and driving across the border and jumping into a plane from time to time to build some new relationships, learn some new cultures is a pretty fantastic thing.
It is. That's great. Okay. So just continue on our theme about, like we're talking about trade and tariff and all that. Do you think from a, the U.S. standpoint, we recently saw their jobs report. It was, looks like their economy is showing signs of slowing down. Number one, do you agree with that? And number two, how do you tie that into the Canadian economy? Like, how does that affect us? Like, if their economy is now slowing down, given the pre-context or the lens of this whole, tariff situation, how do you see that?
Well, it's interesting. I mean, there's a lot of information that is coming up that is very politically tainted. Mm-hmm. So it serves the narrative of the day. But the true aspect will always play it over time. You can only maintain a facade for so long. If you are distinctly reliant on the U.S. economy, which much of Canadian industry is, and you're not easily able to pivot into alternative revenue sources, then it's definitely a significant hit. And as I say, when the U.S. coughs, Canada catches a cold. But my hope is that with this push around the U.S. forcing other countries to become more independent and self-sufficient, that we will build ultimately a more robust infrastructure and a broader scope of who we export our value to, as well as a view on how to enhance the internal consumptive capacity of Canadians, and whether it's capturing more value around refining goods and therefore more and higher paying jobs locally that allow for a more robust consumer base, as well as a responsible immigration policy to bring in more people. The only thing we're lacking in Canada in a significant way is population compared to other countries.
Yeah.
And when you look at the land mass, the natural resources, the ability to support a much larger population, my joke is always when you look at India and you think you're fitting more than 1 billion people in that country and tigers on top of that, and then you look at the land mass and the natural resources of Canada, like we could easily sustain 1 billion people in Canada. It comes with a lot of infrastructure,
of course,
to support, but that leads to a lot of high-value jobs, a lot of value creation. And so at 40 million population, we're not overly self-sufficient, but at 100 million, very likely on our way. And with all the advantages we were given from a natural resource perspective, there's no reason why we couldn't get to that point.
Yeah.
Provided we've got some responsible policies in place to allow us to grow and develop in order to support and provide what's needed for immigrant population, as well as then motivating the current population in Canada to procreate at a greater rate.
Yeah.
Because a lot of the more developed countries, as it becomes more and more first world, living becomes more and more expensive, number of children tends to decline. If you have the ability to support bigger and bigger families through great employment opportunities, then the motivation is there to build a bigger family. And so domestic growth of population, responsible immigration policies, we've got all the natural advantages gifted to us through benefit of geography, where long term we have the ability to support population growth.
I couldn't agree more. We are blessed. I think are we number 1 or 2 for the biggest freshwater reserves in the world? Something like that. We're on the top.
The Great Lakes are a gift.
Right, they are.
For sure.
Natural resources, we have everything, and I couldn't agree more with you. It's the infrastructure that we need, and politicians that are focused on that development long term. But I want to just go back to a few things that you said. You mentioned about some brain drain that, not some, I think it's pretty heavy, where, if you go on the street, you hear this all the time. Oh, inflation is crazy in Canada. Everything is too expensive. I'm just going to move to Florida, or I'm going to move to Phoenix or North Carolina. I could buy a home for $300,000 with 5 bedrooms and this and that. So I think there's a serious weight to that argument, and I would say to our politicians that this is a real problem. This is a real problem. And if you speak to a lot of young people, especially in that age bracket under 30, where you can be more mobile, you're not tied down, they're moving. And obviously, we hope that they don't. Some will, end up moving to a different province, maybe. And I'm saying this with a lens on Southern Ontario. Some will be like, hey, I'll move to Edmonton. Cost of living is much cheaper. Homes are cheaper. I could actually buy something there with a normal salary, which you can't here. So, that's good. But then there's a big population that is like, hey, I'm going to move to Phoenix. I'm going to move to North Carolina. I'm going to move to Texas. Texas is a new tech hub, new Silicon Valley. People moving to, Dubai, Abu Dhabi, Saudi Arabia is a big one I hear these days. So I think that's a real problem, and you don't want to be in a position where, as a country, not only are you're getting double hit because you're getting this brain drain, but then your quality of immigration has gone down as well. And then you're not getting that high quality immigrant that you used to get in 97, 98, 99, 2001, 2002. So you can get hit on both ends of that spectrum. I think that's a really, really big problem that if we don't, address now, it can be not a good thing for Canada in the long term.
Well, agreed for sure. I mean, if the best and brightest in the country are leaving the country, but it all comes back to the assessment of value. There's individuals that have established very comfortable lives, and so have been able to afford themselves a very nice lifestyle in Canada, but are tired of paying taxes. And again, it comes back to a measure of value. If you're paying taxes and you're perceiving significant value for those taxes paid, everything's fine. And again, it's perception of different types of values where when I was in international private banking, most of my colleagues were born in other countries, had immigrated to Toronto to work for the big blue Lion Bank. And one of the principal underlying determinations for them to move here was safety, because they had started a young family. And so whether they were coming up from LATAM, Europe, wherever it was, the perception was that Toronto was a safer place to raise kids and high quality education at a reasonable price. And so there are different perceptions of value along the way, but consistently when you look at the trade between certain U.S. states and Toronto in particular, it's one, the ability to generate more income, more revenue for yourself, and then lower tax regimes to keep more. And so at the end of the day, it's more money in your own bank account in order to experience a higher standard of living. But again, that comes back to, well, if you're paying less tax, there's less services being delivered in exchange for that. And so if you don't have a need for those services, to your point, if you're a single individual with no children, so you don't have to rely on an education system, then yeah, the perception of the value is different. But each city presents its own collection of values that then you go through and individually assess, does it work? And as much as we hibernate in the wintertime, if you go down to the southern states, they're hibernating in the summertime because it's so incredibly warm down there. I've got a bunch of good friends in the southern states that don't spend a lot of time outside in the summertime.
Hashtag first world problems.
Exactly. But again, it's a basket of offerings that you pay a certain price for, and it's an assessment of value of that basket of offerings. If you're looking at buying to relate it to a residential home, if you're looking at buying in one condo building and it has certain amenities that you like, you're willing to pay the common area fees for it. And another building has amenities that you won't utilize, you're not willing to pay for it. And so again, if we can see some consistent reinvestment in the Canadian economy and everything around you is improving, Yes, you've got the inconvenience of construction, and everyone wishes it was faster and more efficient, but it's part and parcel with growth. And so if you see the value in that growth long term, you're motivated to stay. If you don't see value in that growth long term, you're motivated to look at options. But then to your point, it's what offers a better basket of goods around the lifestyle aspect as it relates to your age and stage. But the great thing is the world is becoming a little more mobile, right? You do have the ability to go to Dubai and live for 5-10 years with zero personal income tax and then come back to Canada and start the family if you perceive Canada to be a better spot to raise a family. But again, it's a lifestyle choice. Canada has always been very stable, very consistent from an economic perspective, from a political perspective, from a store of value of assets perspective. And we've got a handful of very livable cities, very beautiful cities, relatively safe, relatively clean. And so it's been a great place for me to raise my daughters. My wife and I have really enjoyed it. That said, as we move into the next stage of empty nest, we're now looking our heads are up. We're looking a little more broadly as to where we may want to buy a second home, spend time working remotely. And so that's definitely in the cards for the next 10, 15 years.
Dubai. Kelly, I have, this is the most important question of today, okay? And this is for all the money. Are you ready?
I'm ready.
911 Turbo S or a GT3 RS? This is for all the money.
So here's my straight up answer. If you are spending all your weekends on the track, GT3 RS, no question. If you are in any way involved in the daily commute, 911 Turbo S, hands down.
Got it. You heard it first here, guys.
But either way, remarkably capable vehicles. Had a lot of fun behind the wheel of Porsches over the years.
Yeah.
And despite not being a direct owner myself, most of our events are Porsche-centric and just an incredible vehicle.
Yeah, I agree. Okay. Let's talk about, for the last little bit of our conversation, I want to talk to you a little bit about, what's happening, tying all of this back to real estate. And I want to get your perspective specifically as a expert on Bay Street. Obviously you have many connections. You've spent a lot of time on Bay Street and other streets across the world and in capital markets. How do you see the street? How do you view the street looking at the real estate market today? And obviously we have a lot of residential, folks watching this stuff, watching our content. So, how does the street view the real estate market?
So, again, with my background, of course, this is my personal opinion and my lens, having spent most of my time not directly involved in the real estate market other than being a homeowner. But the advantage of real estate is its functional utility, its ability to provide a home for either a business or a family. But from an economic value, it's the ability to generate income from that property, as well as then capital gains and value of the transaction if you were to sell the property over a longer period of time. Obviously, real estate is interest rate sensitive. The amount of leverage you can place on a property typically drives its value up. But we're in a bit of an interesting time right now, politically, interest rate wise, immigration policy wise. But there's not a distinct disconnect on the residential side between the employment markets and housing values. But what's interesting in the Toronto market, the least expensive home you can acquire is a condominium. The most expensive home you can acquire is a condominium. Tying into that, if you're going to move further out into the suburbs, public transit, efficient highway systems for the ability to commute into the city if you're working in the city helps to drive demand as well. We haven't done a good enough job in expanding public transit into the suburban areas because because that does drive significant value, convenience of getting to and from places. And so overall, I mean, the underlying value of real estate is its functional utility. There will always be consistent demand for it. It does ebb and flow according to the employment market, according to the interest rate market. But if you're not forced to sell in the down times, you will get compensated for owning real estate. And there's Canada in general has an overexposure to real estate across the board. It's still part of the Canadian dream to own your own home. There's a bit of a trend away from that with the younger generations. And I think part of it is the upward mobility and the more global outlook. A lot of folks, why would you own a home in Toronto if you want to work in the U.S. or in Europe or Middle East? But ultimately, if you're in the city, you need a place to live.
Of course.
If you're in the suburbs, you need a place to live, right? So homes will always have enduring utility. The value will fluctuate. The ability to generate income from it will fluctuate. But there's still significant value in it. And if you're looking at, from a very macro perspective of a Canada going from a 40 million population country to a 60 million population country, there is an underpin of value because there will be relatively consistent demand over the longer term for housing.
Okay. So let me now tie that up with private equity. So we know, especially in core markets, GTA, GVA, in these core markets, real estate prices have been, down over the last number of years. Based on those factors that you spoke about, interest rates, employment rates and whatnot. But as a private equity specialist, would you advise your clients that, hey, this is a great time, let's buy up all the real estate that we can? Or would you say, let's take a more cautious approach? How would you answer that question?
Well, again, from a private equity perspective, you've got a more conservative investor. And so what I've seen more recently is groups that like real estate as an asset class in general, but are now hunting for deals, with this being a buyer's market more than a seller's market. And so they've got certain expectations that are typically a mismatch with the vendor around what they think the property is worth or what it needs to be worth for them to be willing to buy it. But a lot of that comes with the depression of income ability, generating ability from that real estate. But again, if you have some sort of inside track around something where you can get into a property at X knowing that you've got a great relationship with a U.S. company that's looking to expand its manufacturing footprint in Canada, you're willing to buy an industrial building for X knowing that you can sign this group as a tenant and they're willing to pay higher than either market rents or perceived value of rents today, you're willing to pay something that maybe somebody else isn't. That said, the vast majority of Canadian landscape is oligopoly dominated, and it's not that dissimilar on the real estate side, whether it's multifamily, office, industrial, commercial. You've got very large ownership groups that typically are well capitalized and are patient. And so when markets are down, less trades happen, right? They just hold. And if you're well capitalized, you can endure potentially lower income periods. And then when it comes back on the market, valuations start to come back because of positive economic turns, then you can sell if you decide to. But yeah, I find most of the trades during these sort of uncertain times are forced trades. So whether it's a residential home that's being forced to be sold because a couple is divorcing, or a family's downsizing, or there's a job that's been had or obtained in a different jurisdiction. On the company side, it's financial distress of some certain, but typically that's the only motivation to sell in these sort of more challenging times. And so you've got a fairly dry landscape of even comparable sale transactions to determine what the value of your own real estate is. And it comes back to, again, what someone's willing to pay for it, how much leverage a bank is willing to provide. If you're a higher caliber borrower, you can typically still get more leverage based on a solid relationship with the bank to then come in and be able to pay a little bit more to win a transaction. But it's always interesting to see what trades and why during these times because it's not the best time to sell.
Yeah.
So what is it that drives the sale need? And maybe it's an institutional investor that's over allocated, that's forced to sell down in order to rebalance the portfolio. I mean, there's a bunch of different motivating factors, but typically, given how well capitalized and stable real estate is in Canada, you don't tend to find massive swings in any particular asset class other than retail or residential, I should say, over the last few years that's been mainly driven by investors, where as soon as that income number goes upside down against your debt servicing, then all of a sudden your investor market dries up, demand falls off, and so your entry-level home becomes devalued dramatically, whereas if you're having children and the family's growing, you're typically buying a bigger home, and so the demand tends to be relatively consistent on that side, multifamily stuff, but your 500 square foot box in the sky, if the job market isn't robust, you're not willing to endure that, and investors aren't willing to invest in it if they don't have a tenant that's willing to pay more than what their cost to carry is. So, it's an entertaining time. So I've always kept an eye on what trades when and why, because it's always a source of curiosity or a point of curiosity from my perspective as to why something trades. But there's always a tipping point, right? There's always the pendulum always swings. When interest rates gap out, we end up with very little production. As the interest rates drop back down, more demand sweeps in, and all of a sudden we've got a shortage of supply because we haven't consistently built. And so then valuations take off again. Investors start jumping back into the market. So we'll have this sort of boom bust. It'll be interesting to see, again, back to your Carney comment around federal solutions to more sort of prefab, consistent building, which again will help to level out demand, will help to level out valuation. But it'll be interesting to see how it takes off and how impactful it is, because the housing market is such a big, robust market. You have to dump some pretty significant demand drivers or supply drivers in there in order to impact the pricing in any material way. So
when you say investors, and I was watching some some content. Ron Butler actually put this in a pretty good way. We should probably get him on next year. But one of the things that he gave an analogy of is that you have your investors, like your actual seasoned, savvy investors, and we know there's many of them in the real estate game. But then you have the mom and pop investor, right? And the analogy was that imagine you're sitting at a dinner table in 2015 and your uncle says, hey, I just, sold my pre-con assignment condo and made $100,000. And, your nephew, your brother, your sister, mom, dad, oh, really? Maybe we should do that too, right? So I think that's, again, one of those things that needs to be, there needs to be a distinction there, right? Like institutional investor, mom and pop investors. And mom and pop investors, in my being obviously in the mortgage business ourselves, they've completely vanished, and rightfully so. But then again, my mind keeps going back to the same thing, that if you're an institutional investor or if you're a savvy real estate investor, you know that immigration has not stopped. Canada has not said that we're not immigrate. There's no immigration. Yes, we've put a pause on the international student and that whole side of the equation, but immigration is going to continue. So why does it not make sense to go into real estate if you're an institutional investor, right?
Well, again, on the institutional side, it's preservation of principal based on your investor, the value you need to deliver to your investor. Return demands on the conservative pooled capital side tend to be a little bit lower, so they're looking for safer opportunities. And they can't get caught in sort of valuation cycles where they're forced to sell in down markets. And so, but given the significant nature of their capital raising ability, if they're consistently deploying capital into an asset class over years and decades, you've got the dollar cost averaging effect that will be working in your favor. You'll be up some years, down other years, and everything equals out in the end. But from an institutional capital going into residential real estate, given the socialist bent of Canada in general, it's perceived as being a negative thing to have corporate ownership of residential housing. And so while that perception still pervades, there will be, again, coming back to our earlier discussion around what impact does politics have on investing in private assets, that's one of them. And so when BlackRock in the U.S. was gobbling up 25% of available homes for sale, the U.S. being very much more entrepreneurial and open to support of money dictating terms, in Canada we have a bit more of political influence around politics dictating certain aspects. And so there were groups that were trying to push a consolidation of the rental market in the residential side with corporate-owned real estate and providing consistent access to rental properties in core urban centers that were essentially chased out from a political perspective because it was perceived as stealing homes from Canadian families. Whether or not that trues out, it'd be interesting to see if with this new push on sort of the standardized prefab housing push of consistently deploying capital into building more and more homes at the entry level point, if there's a role for institutional capital to play in underpinning that initially. Is that going to be individual homeowner driven, or is that going to be institutional capital coming in, building similar to the Chinese model where it's building neighborhoods on spec and then providing the right incentives to come in and populate those homes, whether that's pricing driven by the house itself or it's more economically driven where you've got manufacturing jobs in a neighborhood, so the town around it is built on spec. You get hired at the manufacturing company, and then you're moving into a convenient home located nearby. Because my understanding of the Chinese model was you build the neighborhood, you create the opportunities for the businesses to come through tax incentives. The businesses establish themselves. They start hiring people. You get the rural to urban migration to come in to get the job, and you start to populate the homes. Canada's typically not taken that sort of speculative build approach. It's taking more of the pre-sale approach. But with this new push from the feds around consistently building, it's going to be interesting to see if there is a role to play from an institutional capital perspective.
Yeah. Makes sense. Now, the $1 million question. Okay. September 16th is the next Bank of Canada rate announcement. What do you think is going to happen there? Are we going towards a hold? Are we going towards decrease? What are you thinking?
Well, I don't see any macroeconomic indicators that would push in one direction versus another, right?
If I can jump in right there for a second, that's what I think as well. Right. I guess maybe I should add this point to my question. If the U.S. Fed cuts their rates next month, are we going to follow suit? Or are we still going to rely on those technical factors?
I would suggest that given the historical stability of the Canadian economy, we would still take a cautious wait-and-see approach to see what impact, if any, the U.S. rate cut, should it come to fruition, has on the U.S. economy, which in turn would then rise the tide in the Canadian economy, given how dependent we are on the U.S. consumer. But at the same time, if we're doing an exceptional job of diversifying our exposure globally from a revenue-generating perspective, we should ideally be insulating ourselves a little bit better from the vagaries of the U.S. market. But again, rate cuts, typically there's not, other than valuations in the public markets, there's not typically an immediate overnight impact of interest rates on domestic consumption, on domestic valuation of private assets. So it will be a slow wait and see from my perspective. And again, if ideally relying on our own metrics to drive our own interest rate policy versus U.S. And again, strong Canadian dollar has served us reasonably well for the years, especially with non-American consumer. So from that perspective, I think it's a cautious wait and see. I don't think there's any overwhelming demand from the consumer population to move rates dramatically. I know there's certain industries that would love lower interest rates from a self-serving perspective. But the flip side of that is if you're lowering rates to increase demand, then you've got still a valuation concern, right? If it's cheaper to borrow to buy something expensive, but it keeps getting more expensive, it still hasn't solved the issue. So I think longer term, as it relates directly to residential real estate, if we start seeing significant supply side solutions coming into the market, couple that with some demand side solutions with lower interest rates, I think that's the ultimate win. Whereas in the near term, if it's simply lower interest rates to make borrowing cheaper to then drive values higher, I don't think that helps us longer term.
But then the question is, and you know, this is your field, so please correct me if I'm wrong. Any central bank in the world, Bank of Canada, U.S. Fed, doesn't matter. They have two very clear mandates, right? Like most central banks, you've got to control inflation and you've got to build an environment where you can push for GDP growth, right? Am I correct in saying that, number one?
I'd agree.
Okay. But right now, in the Canadian, with the macro backdrop, our economy is not doing too good. So why would you not proactively cut rates now, and get ahead of the curve? And that's how I see it. And I obviously this is my opinion. Why not be proactive and cut the rates now, protect the economy, and move forward, rather than taking that more cautious wait and see approach? And how do you answer? What do you say to that?
Well, again, with the principal focus being inflation on that side, with GDP taking a backseat. Again, it's demand drivers and cost of living increases that ultimately drive the interest rate side of it. I think the bulk of the decision making is on the cost of living. And so if you're seeing inflation come in across the board, the last thing you want to do is drop interest rates to then further exacerbate the inflationary environment. That said, not everybody participates equally in the impact of interest rates. And so it's a complicated question. I think the focus historically is caution over exuberance, and seeing the interest rate being more of a reactionary approach as opposed to a proactive approach to try to manage things. So instead of trying to dictate behavior proactively through, if we drop rates, then this will happen. It's, we saw the general sentiment move in this direction, so we're going to react to it by either tightening monetary policy or loosening monetary policy and make it cheaper to borrow, more expensive to borrow. And so it's kind of the economy dictates interest rate policy as opposed to interest rate policy dictating the economy. And I think it's much safer to move in reaction to the masses as opposed to moving and hoping, because there is always unintended consequences, and there's never a direct linear relationship between I'm going to do this at the macro level and have all the micro fall in line. So I think it's definitely easier to move the dial in an effective way in reaction to what the macro is doing. And so that's typically a cautionary wait and see.
That's a very good way to put it. I agree. Okay, I have another one for you. I'm asking Kelly all the tough questions today. So Kelly, if I wrote you a check for $1 million today, okay, and I wanted you to manage that $1 million for me, okay, what percentage of that would you put into soft assets, like your in the stock market, and what would you put into hard assets? Give us a bit of a breakdown of how you would structure out that $1 million portfolio, for example, in today's market. What would you allocate to what?
Well, again, having spent some time in the money management world, it's a complicated question based on age and stage of the individual. And so if I was to use my scenario as the example, I married 2 kids, university age, with a focus on need for income as an augment to principal primary income, but also with a longer term outlook to having a 30-year outlook prior to retirement. There'd be a good mix of risk on assets versus risk off. And so from my perspective, I think because I've been close to entrepreneurs, I've got a bit of a distorted view of risk. And if I don't need capital for 30 years, then we can roll the dice and get a little more aggressive, play in some more interesting things. That said, I put all of my money in the hands of professionals, despite being in the industry myself. So my nest egg is well taken care of by a very industry veteran. But from that perspective, it ultimately, what does the money need to do for you?
Right.
How quickly do you need to access it? Does it need to generate income? Which, if you don't need income, then obviously your focus is more on the capital gain side. If it's capital gains, you've got the ability to dip into the private asset world, buy and hold something that's less liquid for a longer period of time. If you need access to liquidity, you're paying for the kids' university education with that, or you're paying for upcoming weddings with that, buying a new house, buying a new car, then you're going to have focus on near-term, liquid, safer assets. But again, it ultimately comes down to what does this $1 million need to do for you? And from my perspective, that million needs to turn into 30 in 30 years. So I'm looking at more risk on. So if it's in public markets, it's more looking at certain emerging markets, emerging technologies. It would skew on the private side to a view at kind of very distinct, specialized venture capital type opportunities, where from a macro perspective, it makes sense that this would trend well over the next 10 years, 15 years. Not so much a focus on income in the near term, given my wife and I are both gainfully employed. So yeah, it would be exploring. It's going to be interesting to see what digital currencies do over the next little while as they become more regulated. It's funny, the initial appeal of them being sort of outside of any sort of government control, sovereign interest or sovereign influence. The fact that they are coming under the influence of the sovereigns is actually making them more broadly accepted and driving the value more recently. So as it becomes more accepted as an institute or a medium of exchange, it'll be interesting to see what gets adopted, how it gets adopted. So in the near term, hedging the bets. I did grow up as a commercial banker, so there's still some risk underwriting there. A diversified fund that has exposure across a broad basket of currencies. When you look at the rise of the need for energy to drive a lot of the AI that's happening. So are you playing picks and shovels in the AI game? Are you picking specific names? With a longer term outlook, you have the ability to pick specific names to go in that. So yeah, it's a very interesting investing environment. There's a lot of groups that just fall back on what they know. We develop real estate, and that's all we've ever done, and we've never lost money, and so we continue to do that. In the low times, we just stop investing. Good times, we invest more. But from a global sort of more macro perspective, the other view of the U.S. impact around self-actualizing for all these countries that have leaned on the security blanket of the U.S. is now there's a huge push over the next 10, 15 years on building up military capabilities within each country.
We're doing that too in Canada, right? Like
exactly.
We announced some investments in that space.
So we have an established reputation as leaders in technology. And so that's why you should look at us. And if there's some concerns about what's going on around the world with the ongoing conflicts, we recognize that, and we've adjusted for that by focusing on defensive technologies. So if you believe in the right of every sovereign to defend themselves, then these are the technologies that you should be investing in. We're not in any sort of aggressive forward things that go boom armament side of it. And so regardless of political affiliations, this does make sense. If you invest in this technology, we're selling it to countries around the world. And so you can sleep better at night knowing that you're allowing a domestic population to defend themselves from foreign threats, as opposed to allowing domestic populations to then inflict pain on their neighbors. So it's an interesting angle, but money finds a way.
So companies like, and I think we've spoken about this before, there's a lot of like hype around some certain IPOs. One of the ones that I've been hearing about nonstop lately is Anduril, defense tech. How do you see that? Would that be a buy in your book?
I think with the way the macro is playing out, and with the sitting president having another 3-year run, I think that trend will continue. I think rising tide raises all ships. So you can play the next sexy IPO if you want to go that way and get specific names in the portfolio, or you play a broader basket of diversified defense industry contractors that supply that area. Or you can look at different technologies that have the ability to be deployed across a broad section of industries, one of which is military, and get the lift in the near term from the military and then the long term from everything else. And so there's a bunch of different ways to play things, but the military side is definitely hot, given the U.S. influence on them pulling back from financing foreign wars. And so I think there's definitely a strong play for military-centric, and very quietly, Canada plays a reasonably significant role in the military-industrial complex, both for domestic consumption and international consumption. So it's definitely good for Canada in general as well.
That's great. Thank you for that. Now we're going to ask the real tough questions. Should we shut off the U.S. electricity if they don't stop? Just kidding.
What's interesting about the way things play out is we punish the domestic population for political spats. And that's the part that doesn't make a ton of sense for me, is we've been neighbors since inception, and that's not going to change.
Not going to change.
And so
you mean that we can't pick up Canada and go somewhere else?
No, and we're definitely not willing to move further north away from the southern border in order to live. So again, it's the domestic populations that suffer equally and broadly when you've got the U.S. that's split 50-50 between Republican and Democrat, and yet 100% of the population suffers under tariffs and that sort of blowback. Not dissimilar, friends of ours have chosen not to travel to the U.S. For domestic vacations in the next little while because of the rhetoric, specifically around the 51st state and what was seen as disrespectful discourse. That said, when I dug in a little deeper around Nashville was the specific target of conversation, it actually voted Democrat. So I'm like, why not support Nashville as a Democratic voting population instead of punishing them within the broader sweep of what was seen as sort of Republican rhetoric? So from my perspective, I still travel to the U.S. Without hesitation, because I deal with people, and those relationships are still meaningful regardless of, politicians come and go. And we've endured a lot of different views in the different political spheres. But from a day-to-day, we all need to make money. We all need to support our own lifestyles. And so I consistently do business with people that I like and enjoy, even with differing political opinions. So at the end of the day, if they're good quality people that I enjoy doing business with and we add significant value and receive value in return, regardless of who's shouting from what hilltop, I still focus on consistently executing in that regard. Now, it does make life a little more entertaining, and potentially a little bit of tap dancing here and there to avoid the political will of the day. But still, I mean, business has to be dynamic. It keeps you on your toes, keeps your edges sharp. In Canada in general, there's a lot of positive that's come out of this most recent political rhetoric around interprovincial trade, focus on nation-building projects, which I think are good for us long-term. And I think the fact that we were just very comfortable living in our own provincial silos, pumping our products into the U.S., brought us into a bit of a lull, which we've ideally woken up from. And so if it does spur a lot of that, then fantastic. And we've got a lot more Canadian flags waving in front of houses now, simply because of the U.S.
Absolutely.
And so that part of it, the national pride aspect, is fantastic. And just a shout out to our local men's national team, beat the U.S. by 2 points in basketball at the Global Jam.
Love it.
Defend our home turf. So, yeah, listen, it all ebbs and flows. The political environment will sway. The pendulum always swings one way or another. Everyone gets their time in the spotlight, but on the quiet side, on the private side, on the have to put food on the table side, you still have to figure out a way to get things done.
Yeah.
And there is no way to avoid this big, beautiful country to our south. And there's a lot of amazing people down there that I've had a lot of fun doing business with over the years, and that's not impacted. I'm not diverted from that based on who's in office.
I completely agree with that. How do you see the future of, obviously Donald Trump is talking about drill, baby, drill. Do you think the EV market is dead for the next 10 years?
Well, the EV market, as it relates to residential cars versus, I see a huge rise in electric automation. And so I'm having conversations with different manufacturing facilities being set up for inexpensive electric vehicles that are more for commercial use.
Commercial use, okay.
Than they are residential use. I think the challenge with the lack of infrastructure and the inconvenience on the charging side.
Tell me about it.
Whether it's perceived or whether it's real, the exception tends to make the rule. And so if you get half the range in the wintertime and you're in a four-season climate, it makes it difficult to get up to the cottage in the wintertime. But it doesn't impact your day-to-day commute to the office where you're just plugging in overnight, charging effectively and efficiently. But again, it comes down to consumer choice. So I don't see electric vehicles going away. There's been too much invested in that in order for it to go away. But again, it's going to be more of a balance. Historically, it's been early adoptions driven by government incentives. Those incentives fell by the wayside, whether that was a political decision based on two very expensive men getting into a spat, or whether that's going to be something that stays away long term. Ultimately, once manufacturing scope and scale, and you look at what the Chinese have done around scope and scale on the manufacturing side, they're quietly distributing vehicles all over the world, just not North America because of the tariff regime. Now, if you start to find superior value in products overseas versus what you're consuming domestically, there will be a user-driven push to bring that onshore, which then, under the right political regime, everything's negotiated. So we'll see. I mean, electric cars are here to stay. It's funny, they were around 100 years ago, and then combustion engines came in and took over.
One of the really things that really stuck out to me about this whole EV situation is, and you may know this, but one of the biggest investors in Lucid is the Saudis, and they're one of the biggest OPEC members. So that always stuck out to me. You're like, why do that? Do you think something like that is more of just a play on markets and where they think the future of EVs is, or do they know something we don't?
Well, excellent question. I would spend a lot of time in the Middle East. That said, when you have significant capital to deploy and you're just looking for a return on it, and you want to play emerging trends, obviously EVs is one of those. But on the flip side of that as well is when you look at air pollution challenges with some of the bigger urban centers, EVs is a convenient means of near-term, short-term elimination of automotive emissions in major urban centers, like when Beijing hosted the Olympics and half the vehicles weren't allowed to travel into the city on any given day. You had a major alleviation of some of the air pollution challenges, right? And so you can see potentially a future in the Middle East where the major built centers are only electric vehicle in the major population centers, and then all the commercial vehicles around that service that are all still combustion. Because nobody's going to throw the baby out with the bathwater around full aversion to what generated the wealth.
Mm-hmm.
That said, it is a prudent approach to diversify your investment options with the surplus income generated off the oil and gas. And so Elon did an amazing job of making electric vehicles attractive. And so they were adopted by the consumer. And then now it's just a matter of whether or not the infrastructure builds up to support to make it incredibly convenient on par with a combustion engine to then make it up to consumer choice around what it is they want to go with.
You mentioned Elon, I didn't. Again, he mentioned Elon, I didn't. So I saw a video of a theory that Elon creating EVs, Elon creating, talking about creating underground tunnels, solar energy, all that sort of stuff it is bid to, because, he wants to move to Mars. And you need all of this stuff to move to Mars. Underground tunnels, solar energy, EV, Neuralink, all of these things tie into that vision. Is he a evil version of Tony Stark, or are we just reading too much into conjecture here?
Well, he has had a brilliant ability to attract capital over the years. And from what I've heard him described as, is an incredible ability to distill complex situations down to more easily digestible and executable approaches, and a very distinct unwillingness to accept no for an answer. And so the status quo doesn't mean anything. And so when you say rocket travel is too expensive, he makes a recyclable rocket, right? When EVs are in the market currently are unattractive and basically only manufactured because they're being forced to, he comes in and makes an attractive electric vehicle, puts some sizzle around it, and next thing you know, it's worth multiples of what all the other domestic manufacturers are of combustion engines. So he does have a certain special flair to him. That said, if it's only an individual of significant commercial brilliance that can pull something off like that, is it sustainable? Does the valuation of Tesla hold if Elon's no longer around? Arguably not. But yeah, having somebody, it's Neil deGrasse Tyson argues about the funding of NASA and the inspirational aspect of having an organization like NASA. Like all of a sudden we're thinking about a world bigger than our own, right? And the inspirational impact of that, the fact that he has this outlandish desire to populate Mars, the fact that it's under current standards impossible, doesn't lessen the impact of the inspirational aspect of what would we need to do to get there, and the innovation that's driven for domestic consumption in order to get there. So improving life on Earth based on the aspirational of populating Mars. And so a lot of the technologies that have spun out of NASA with their desire to get to the moon has had dramatically positive impacts on our day-to-day here on Earth.
Yeah.
Right? When you have no desire to get to the moon, but Velcro works pretty well, right? And so it's the unintended consequences on daily life here on Earth that are born from the desire to become extraterrestrial.
Yeah.
Yeah.
But you got to agree with me. He does give off the evil villain vibe sometimes.
He plays the role well.
Yeah. We'll leave it at that. Last thing I want to talk to you about, Kelly, and we haven't talked about this so far, is AI. And obviously it's the new shiny, not new, but it's a shiny thing everyone likes to talk about these days. My question to you would be is this. I read a thesis on this, that AI is not coming for your blue collar jobs. It's not coming for electrical, commercial electrician, plumber. It's not coming for those jobs. It's coming for the jobs of white collar, what we see, coders, programmers, that sort of stuff. I was giving a presentation somewhere, and I was trying to give an example of a self-employed IT consultant or IT business, and I said, hey, let's imagine if you're a web developer. And then I caught myself. I'm like, I don't think those exist anymore. I think you can do that all with AI these days, web development and whatnot. So I caught myself. How do you see that? How do you see that AI revolution? And if we can somehow tie it to Canada, that would be really cool. How do you see that?
Well, any sort of automation is deflationary as it relates to employment, whether it's mechanical automation through robots or hard technology software innovation through like the rise of AI. So the real trick from a business owner perspective is how do you leverage that to augment what your employment base can accomplish? So on the one hand, it can be deflationary where you say, okay, without any growth, I can turn 300 employees into 100 and replace it with software or hardware, which in my mind is the view of a sort of a lifestyle business. Whereas from my perspective, it's how do you take the 300 employees and 3x their output by overlaying software, and whether it's software or hardware, and then force yourself as a business owner to have a much broader view of the impacts you can have and how competitive you can be. And so it does level set quite a bit. Whereas like if you're a lawyer, you've gone through years of being an articling student and researching the law and understanding all the subtle nuances. And so you had an advantage over someone that hadn't had that education, where you can throw a question to ChatGPT and have it come back with whatever, 90% accuracy, and you're 90% of the way there in 15 seconds versus 5, 6, 10 years of toiling. So it does kind of level set a little bit and help to chip away at the value of that time and toil spent. And so if it ultimately gets to the point where it's 98, 99% accurate, undoing all these things, web coding, accounting, legal work, from a bank perspective, underwriting, it will be pretty interesting to see how the human population pivots to maintain relevance and still find ways to add value and get compensated for that value. And so in theory, it would force people to level up, to add more and more value. That's more on the creative side, because everything that these large language models are consuming is what's been published in the past.
Mm-hmm.
And so as yet hasn't made that leap to creating stuff for the future. It's very good at regurgitating what's been published previously. And so the human population is still that one that's looking out 5, 10 years around creating new value. But it is interestingly disruptive around white-collar jobs, which are typically seen as the more cerebral jobs, where if you can automate the cerebral, then okay, what's next? So it'll be interesting to see how everybody reacts. It will allow a smaller country like Canada to punch above its weight class if it adopts it and uses it effectively, to compete with bigger established players. And it'll allow smaller companies to compete with bigger ones, domestic companies to compete with international ones, and the ability to translate through different languages. Be interesting to see and explore. So I'm excited about it. It's from that dystopian perspective of, okay, the machines rise up and take over the world. The humanoid robot aspect has not caught up yet to the point where you can then plug it in with some self-learning AI to then think and act on its own. But we're not that far off from the humanoid robot aspect of it either. So it'll be interesting to see how it all goes. I'm excited about it, as well as concerned in certain aspects. But the human population has proven over the centuries to be very adaptive. And ultimately, that's been our ability to collectively come together and overcome challenges, and has allowed us to rise to the top of the food chain. And it'll be interesting to see the impact of a self-created challenge, how that impacts and how we adapt and look to overcome it. I think from an employment perspective, it's more of a concern for the next generations. Because when I look at the rote repetition being eliminated by LLMs, the value add is still there.
Mm-hmm.
The fact-checking aspect, hey, does this make sense, is still there. But this next generation coming up that has that educational opportunity eliminated doesn't have the experience to then look at a produced body of work and say, okay, does this make sense? Right? And so those that have the experience can leverage that, but then those that don't have to figure out what's next, right?
Yeah.
And so some of the fastest growing jobs are in AI consultancy, teaching old people like me how to actually use the tools. So the younger generation can easily jump on that and lead that charge. But then once everybody's well trained on all of it, then what happens? But I like the augmenting aspect of it.
I agree.
And I like that having the software portion eliminates a lot of the need for the physical infrastructure portion. You can create chatbots that can be on the other end of a medical call that will alleviate the need to go in and see the doctor to ask that question. And under certain circumstances, you can get reasonable answers for things. For more serious things, obviously you're going in and still talking to the experienced expert, but it can alleviate some of the pressure on some of the built infrastructure. But yeah, adopting technology has always historically been deflationary from an employment perspective. That said, everyone seems to be relatively adaptive over the years to figure out what's the new way to make money. But we could end up with this kind of dramatic shift between trade schools and universities, where now trade schools start to become the more perceived as the more value add, because AI is not yet swinging hammers and unclogging toilets and doing commercial HVAC work and that sort of thing.
And this is how good these conversations with 812 podcast is. We just uncovered a new play, a new business opportunity right there, investing in trade schools. Kelly, thank you so much for coming on. Really, really appreciate you and your time and sitting down with us today. Folks, you heard it first. Kelly Burke, co-founder, IFES Global. We'll leave all of our contact info and social profile links for you in the comments below. Connect with us, reach out. We'll see you on the next one. Thank you so much.